Would you like some more help to achieve your secure retirement and financial independence faster? How about some more help so your employees, if you're a practice owner, can have a better chance of achieving their secure retirement? Today I'm interviewing my colleague, Jessica Nelson, about the Secure Act 2.0, some proposed legislation in Congress with a good chance of becoming law. If it does, this extra retirement help could soon affect you and your colleagues. So now is the time to understand how you can benefit the most from it. Hello everyone, and welcome to Wealth Matters for Physicians by Altfest Personal Wealth Management. I'm Mike Prendergast, a director at Altfest's Healthcare Practice Group and the host of this channel, which provides key investing and personal financial planning insights to help physicians achieve their important financial and life goals. Before we bring in Jessica, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal finances in a fully objective, fee-transparent manner, while as a legal fiduciary, always putting our physicians' best interests first. Altfest is honored to be the preferred wealth manager for members of the Medical Society of the State of New York, the preferred wealth management education provider of both the New York chapter of the American College of Surgeons and the New York State Society of Orthopedic Surgeons, and a corporate partner of the Medical Society of New Jersey, amongst other associations. As I mentioned, my guest today is my colleague Jessica Nelson, who some of you may recognize from a previous appearance on Wealth Matters for Physicians. Jessica is a financial advisor at Altfest Personal Wealth Management, where she helps our clients optimize their investments and all other areas of their personal financial lives. Jessica is a CPA, a certified financial planner, and has a master's in financial management. This is the first of two videos with Jessica Nelson on how the Secure Act 2.0 could positively affect your retirement success. I think that you'll find the information that Jessica will provide very beneficial. And once you hear it, I think you'll hope, as I do, that this legislation, which has bipartisan support in Congress, will be passed quickly. Jessica, thank you very much for being with us again today on Wealth Matters for Physicians. So before we dive into today's discussion about Secure Act 2.0, Jessica, how was your weekend? What did you do? Anything interesting in your time off?
Yeah, my weekend was great. Well, one, the weather was beautiful, so that's always a plus. And then also I got to meet up with some college friends, and we did like a little brunch boat ride, so that was really nice.
Oh, wow. And the weather was great, so that must have been, you took some pictures?
Yes, I did. I actually got a really good picture at the Statue of Liberty. I don't think I've ever been that close to it, so that was nice.
Excellent. So Jessica, I know we're here today to start talking about the Secure Act 2.0 and all the things that it's going to be, all the enhancements. But for our physician audience, can you give us a little bit of refresher on Secure Act, I guess, 1.0 and why there was perceived a need to have a 2.0?
Yeah, absolutely. So the original Secure Act was one of the largest legislations that we've seen in over a decade related to retirement planning. And really why that came about is there was a lot of conversations around Americans just not being prepared for retirement. They didn't save enough. Maybe they didn't feel like they had enough time to save. Maybe they weren't aware of some of the options available to them. So the Secure Act came to be. And really what the Secure Act seeks to do is address those problems by enhancing the availability of retirement plans in the workplace. So how did they do that, right? One thing that they did was trying to create incentives to employers to offer plans to employees. So specifically for small business owners, what they did was increase the tax credit for opening new plans, as well as increase a new tax credit for automatic enrollment. So one thing that the Secure Act did was offer a tax credit for employers who automatically enrolled employees into their retirement plans. In addition, the Secure Act actually moved what's known as the RMD age, so the required minimum distribution age, which is the age you have to withdraw from your plans. It was moved from 70 and a half to 72. So there were a number of provisions in the original Secure Act, but those were some of the key ones.
Great. And so why were legislators thinking that we needed to have a Secure Act 2.0? What was the reason?
Yeah, absolutely. So when the original Secure Act came out, there were a lot of discussion of people saying it just didn't do enough, right? The main problem being that not enough people were participating in their plans. They didn't feel like there was enough done to address that issue. So in the Secure Act 2.0, we're seeing that issue being addressed as well as a number of issues.
Thank you. So great. So Jessica, now we're going to talk about some of the proposed enhancements or changes that are coming in this proposed Secure Act 2.0 legislation. First of all, regarding mandatory automatic enrollment, what is the current situation right now and how is the Secure Act 2.0 change things?
Yeah, absolutely. So under current laws, employees have to opt in to participate in their employer-sponsored retirement plan. Versus in the proposed law, any new plans would have to automatically enroll employees. So this was actually one of the biggest criticisms of the original Secure Act. People felt that in order to promote saving more for retirement, that employees should just have to, automatically be enrolled in it, and if they didn't want to opt out. So in the Secure Act 2.0, we're fixing that shortfall that we saw in the original Secure Act.
So going from opting in to having to opt out if you don't want to be in it.
Exactly. And this would be for any new plans created once the Secure Act 2.0, were to pass. There are a few exemptions. So for any church organizations, for any governmental organizations, they would be exempt from having to have this automatic enrollment, as well as for certain small businesses, as well as new businesses, which is defined in the proposal as being in operation for less than 3 years.
Great, thank you. Great, so Jessica, now let's go on to catch-up contributions. So first of all, what is a catch-up contribution?
Yeah, absolutely. So a catch-up contribution is a contribution that you're able to make once you reach a certain age that is above the standard limitations. So if you're thinking about IRAs, currently, if you are 50 or older, you can make an additional contribution of $1,000 into that plan. For employer-sponsored plans, that amount is $6,500, and for simple IRAs, which are IRAs for small businesses, that amount is $3,000.
Great, and then how would that change if the Secure Act 2.0 legislation were passed?
So one thing that the Secure Act 2.0 does is it indexed that amount to inflation, which is a huge deal. So when we're thinking about the IRA contribution, the catch-up amount, that was set back in, I believe, 2006, right? Which is a long time ago. So what you could have done with $1,000 in 2006 is not what you can do with it now. And it's certainly not will be what you can do with it once you retire, right? So that's one of the biggest changes we're seeing to the catch-up contributions. Additionally, they are enhancing the amount for individuals between the age of 62 and 64 for employer-sponsored plans. So for those individuals, the catch-up amount would actually be $10,000 for 401ks and 403bs, and for simples, that would be $5,000.
So now moving on to the delaying of mandatory distributions from retirement plans, what are the new changes that the Secure Act 2.0 would create?
Yeah, so the Secure Act 2.0 further pushes back the RMD age. So under the current law, you have to start withdrawing from your retirement plans once you are 72. But the Secure Act 2.0 is calling for is to push that back to 75. And the way that would happen would be gradually. So when the Secure Act 2.0 is or was to pass, it would start out at 73, and then the following year would be 74, and then finally we would reach 75.
Okay, great. And also, Jessica, I heard that some people might not have to take required minimum distributions under the Secure Act 2.0. Is that correct?
That is absolutely correct. So under current laws, no matter how much your balances are in your plans, whether you need the funds or not, you are required to take a minimum amount. Under Secure Act 2.0, individuals whose account balances do not exceed $100,000 actually wouldn't have any RMDs. So this is great because it allows for more flexibility, especially when we're looking at people with lower balances. This could be extremely helpful for them.
That's great because they'd be able to get more tax-deferred growth and only take out what they need. And Jessica, I think I heard that there was a reduction in the penalty for failing to take out the full required minimum distribution that one needs to, if one needs to. Is that true?
Yes, that is correct. So currently under law, if you do not withdraw how much you're supposed to, there's actually a 50% penalty imposed, and this is on top of your regular taxation. So this is pretty significant. Under the proposal, that would be reduced to 25%, which is half, right? So this is a pretty significant change.
Great. So then moving on, I hear that there's some changes in the way that qualified charitable distributions occur under the Secure Act 2.0. Could you tell us a little bit about that?
Yeah, absolutely. But before I dive into that, let's just give a little background on what qualified charitable distributions are.
Great idea.
So qualified charitable distributions are distributions that you can make directly from your qualified retirement plan and donate that to charity. So usually when you withdraw from these plans, that amount is taxed at ordinary income to you, right? The same way you would treat wages. What qualified charitable distributions do, or QCDs, it allows you to satisfy those RMDs, but since you're donating that amount to charity, you don't then have to report that amount as ordinary income on your taxes, right? So this is a huge planning opportunity for many people who are in retirement.
Excellent.
What the Secure Act 2.0 would do would increase the amount that you're allowed to make. So under current law, each individual can do QCDs up to $100,000. Under Secure Act 2.0, that would be $130,000.
Great, and I think there was something about, do you have the ability to put the QCD into like a qualified charitable remainder trust?
Yes, absolutely. So what those trusts are trusts where you can put an asset in, right? And you can set up kind of two beneficiaries. You can have a beneficiary for the life of the trust, whether it be you or maybe a child or someone else who would like to benefit from that asset. And then once that period is done, that asset then goes to a charity. So this is great for people who care about donating to charity, but also want to benefit from this asset. So under the Secure Act 2.0, you would actually be able to utilize QCDs in combination with these trusts. It would be a one-time thing, and it would be limited to $50,000 per individual.
Excellent. Sounds like a very good, like you said, it's one nice way to give to charity, but you also either get some back for yourself or some income comes back to a loved one.
Yes, absolutely.
Great. This is the end of the first part of our interview with Jessica Nelson about the Secure Act 2.0 and how its proposed changes can help you get to your secure retirement sooner. Please join us for the conclusion of our interview with Jessica Nelson in our next video. If you'd like to discuss the information explained in today's video, receive a complimentary analysis of either your investment portfolio or retirement readiness, or discuss any of your other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732 or by emailing Jesse at his email address, which is also in the description of today's video below. If you like today's video about providing insights to help physicians optimize their personal finances and achieve financial independence, please click the subscribe button and hit the bell icon below to receive notifications each time we release a new video. If you think that a fellow physician would find this video interesting or useful, please share it with him or her so that they can also optimize their finances. Lastly, as always, this channel is for you, and we want to make it as useful and as enjoyable as possible. If you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we would love to hear from you. So please share your comments with us in the comments section below. Thank you very, very much. Well, that's all for today, physicians. I look forward to being with you again in our next video. And until then, be well and remember to keep on optimizing your finances.